For more than half a century, Luxembourg has been a centre of excellence for international and cross-border financial services. Having flourished alongside European integration and the common European market, Luxembourg today acts as an EU hub and competence centre to the world's leading financial institutions. Catering to the needs of global investors, the financial centre provides a unique combination of international expertise, a complete toolbox of investment products, and highly specialised financial institutions and service providers. From wealth management, treasury and corporate banking to fund services, banks in Luxembourg have specialised in serving clients across borders. In Europe's leading fund centre, asset managers find the perfect ecosystem to launch and distribute funds to investors across the world. Luxembourg's insurance industry has decades of experience in developing solutions to meet the needs of highly mobile citizens of multinational companies. Centre for international debt listings, securitization and post-trade services, Luxembourg is the right place for companies to finance their global activities. English-speaking regulators and administrations, access to a multilingual and highly skilled workforce, a AAA-rated stable economy, an innovation-friendly digital nation, an international business environment right in the heart of the European continent. Luxembourg provides the ideal environment for international banks, asset managers and insurance companies to thrive within the European Union and beyond. Grow beyond borders. Luxembourg.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Ladies and gentlemen, thank you for joining us and welcome to today's event focusing on the Capital Markets Union. The world in which the Capital Markets Union project exists today is substantially different from the one when it was launched back in 2015. Back then, Brexit was a mere glimmer in the eyes of Boris Johnson and David Cameron. Back then, the Paris Agreement, which catalysed action on green finance, was still several months off from being signed. And back then, one could perhaps say that fintech and digitisation projects were still very much in their infancy. That being said, the Capital Markets Union project is perhaps even more relevant today than it was back then. Its stated aim is to get money in the form of investments and savings flowing across the European Union, and this for the benefit of consumers, investors and businesses. And as we emerge from our COVID-induced isolation, this will be more important than ever. We have an excellent selection of panellists and speakers to guide us through the topic today, so without further ado, let's get started. So it's my pleasure to first be able to welcome Adam Farkas. Adam doesn't need much by way of introduction. He currently serves as Chief Executive Officer for the Association for Financial Markets in Europe, otherwise known as AFME. Prior to joining AFME in 2020, he was the Executive Director of the European Banking Authority, where he managed the organisation's daily operations and led the implementation of its regulatory work programme. Before that, he has held a wide variety of other high-ranking positions, including chairman of the Hungarian Financial Supervisory Authority, CEO for Allianz Bank, co-CEO for CIB Bank, and managing director and member of the board of the National Bank of Hungary. Adam, thank you for joining us today, and the floor is yours.
Thank you. Firstly, I would like to say that I'm delighted to have been invited to participate in this event organized by Luxembourg Finance, the topic of which is very much a priority for us at the Association for Financial Markets in Europe. For those of you who do not know us, AFME represents participants in Europe's wholesale financial markets. We have over 180 members from across the industry, universal banks, regional banks, investment banks, as well as law, accountancy, and other professional services firms. Our mission is to promote stable, competitive, and sustainable financial markets that support economic growth and benefit society. The Capital Markets Union is, of course, very relevant to our mission and to our members. But why is it so important? In considering the CMU project, we first have to understand why capital markets are an important part of a growing and prosperous economy. As income is generated by households, there is a need for a mechanism through which funds can be transferred to the improvement and expansion of an economy's businesses. This is, of course, investment, which can take many forms. As we already know, Europe is heavily reliant on investment that originates from the financial sector, that is through loans from banks. In of itself, this is not an issue. However, to ensure that there is diversity in the investment base, a variety of investment sources should be tapped. This is to both increase the overall capacity for investment, but also to provide robustness and stability should a given source be materially impacted. A key source of investment in many market-based economies are households themselves directly investing into businesses. Corporates, too, can invest with profits, but these activities require a marketplace that enables such direct investments to occur. This marketplace is one where different types of capital, debt and equity instruments can be traded depending on the needs of the issuing business and the risk appetite and financial needs of the investor. In having a safe, deep and diverse capital market, investors and businesses are able to transact more efficiently, at lower costs, at greater speed, and with more choice on the instruments that are available. Simply put, capital markets provide a means to transform savings into investments and are an essential driver of economic growth, wealth creation, and funding diversification. When considering the European case for capital markets, we see a number of different markets operating typically within national borders and a great amount of untapped funding. In Europe, there are high rates of savings. In fact, in Luxembourg, we see the highest rate within the EU, 21.4% of gross disposable income in 2018, with an EU average of 11.4% in the same year. Savings rates have also increased dramatically over 2020 as precautionary action is taken in light of the impact of COVID-19 has had on Europe's economy. With the second quarter of 2020 seeing an EU 27 average savings rate of 23.4% of gross disposable income. This represents billions of euros that households have either not been able to spend or have wanted to keep back a safety net in what remains an uncertain time for many of us. As economies begin to reopen, we should expect some of this pent-up demand to provide a much-needed boost. But many businesses will find themselves needing to invest to grow supply, to recapitalize, and to replace the debt that has been accumulated to see them through tough times. Historically, however, the investment rate of households in the EU 27 by comparison was only 8.6% in 2018 and 8.7% in 2019. Even before the pandemic, there was a clear gap between savings and investment and the need to facilitate the growth of Europe's capital markets to help Europe's economy. This gap is only likely to get bigger as savings dramatically increase and the need for investment, and in particular the recapitalization of Europe's businesses, grow further. The Capital Markets Union is a means to promote investor participation, to build momentum, and to help meet the needs of businesses and consumers through multiple initiatives under the CMU banner. An integrated and well-functioning CMU would strengthen the EU's competitiveness, growth, and job creation. But what do we really need from policymakers to make capital markets more accessible so that more direct investment can be undertaken? First of all, let's talk about MiFID II. key part of the existing capital markets framework that underpins much of the work under the CMU umbrella is MiFID. The forthcoming review of MiFID II will be fundamental to promote diverse and well-regulated EU capital markets that support the needs of investors and consumers. An integrated and competitive trading ecosystem is vital to support capital raising by companies, investor returns, and enhance the attractiveness of EU financial centers. In AFME's view, there are two principles which should guide the MiFID review. Firstly, it should focus on outcomes for investors and corporates. The review should be aimed at improving the state of play for users of capital markets. It should not focus on banks or exchanges, but on savers, pensioners, and issuing corporates to maximize their returns and reduce their financing costs respectively. EU investors and end users are the ultimate beneficiaries of capital markets, and pursuing best execution on behalf of end investors is a key investor protection principle that should be preserved. Secondly, it should be evidence-based. The MiFID review must be anchored on a thorough impact assessment of the benefits and costs of any proposed changes. Let me use an example to illustrate. Some stakeholders have expressed the view that an increasing amount of trading occurs on dark venues and on investment bank systemic internalizer platforms. AFME has demonstrated in a report entitled Understanding the Liquidity Landscape in EU Equity Markets that this perception is not accurate. When distinguishing between so-called addressable liquidity, i.e. price-forming transactions, and non-addressable liquidity, non-price-forming transactions like give-ups or other intergroup transactions, one can see that this is not the case. This underscores the need for careful impact analysis, and in our view, the trade reporting framework could benefit from enhancements to clearly show how trading happens in practice before future policy decisions are made. Capital Markets Union, market structure. We believe an effective review of MiFID II should focus on market structure efficiency and well-calibrated transparency regimes in equity and non-equity markets that support liquidity, market confidence, and EU competitiveness. One of the goals of the CMU is to promote equity finance. A good trading ecosystem serves that objective. Maintaining strong and competitive secondary markets goes hand in hand with the aim of having well-developed primary markets, and thus also promoting IPOs and contributing to the necessary re-equitization of Europe's economy. To achieve this, we believe that a diverse and well-regulated capital market with a range of trading mechanisms and not reliant upon one category of trading venues best supports the needs of investors and their customers. By promoting competition, a diverse trading landscape lowers costs and promotes the growth of well-regulated capital markets, ultimately benefiting customers, pensions, and savings. The existing equity market structure rules in MiFID are a relatively complex set of interconnected rules which act together in a very carefully calibrated balance. AFME advises caution on considering the removal of the existing waivers or exemptions just for the sake of simplifying the rules, while underlying trading realities remain complex. Investors have different needs, and it was demonstrated that each type of waiver serves a specific need of investors designed ultimately to keep costs low for pensioners and savers. Next topic of Capital Markets Union is transparency. Within MiFID, there is also an issue of data transparency. I'm encouraged to see in the CMU action plan that the Commission intends to take forward the establishment of a post-trade consolidated tape for equity instruments and is considering a similar tape for bonds. While there are challenges to address, this has the potential to democratize access to European markets by providing all investors with comprehensive and standardized view of the European trading environment. Connected, however, to this is the cost of market data, which is an issue that must be addressed, as the success of a consolidated tape will be closely connected to the price at which the provider of this information obtains the input from data from venues. Capital Markets Union, let's talk about investor protection. I will add that the Commission has rightly put retail investors at the heart of the CMU. Direct retail investor participation should be carefully nurtured, and indirect participation of pensioners and savers should not be less favorably treated. We support establishing a more proportionate investor protection regime for the benefits of the end investor, including a better differentiation between professional and retail clients in key areas. This will only add to the attractiveness of engaging in capital markets for not just Europe's citizens and businesses, but those beyond our borders. And lastly, competitiveness of the EU capital markets. There is an importance of open and interconnected global markets. We must all recognize that markets are globally interconnected, and as such, the international dimension of the CMU is very important. A primary focus of the CMU should be on building capacity within the EU. Developing the CMU is not an objective in itself, however. Its purpose is to support economic growth in Europe, both from internal and external sources. Maximizing efficiencies in the EU's internal capital markets by harmonizing standards and removing barriers between EU member states, while vitally important, will only go so far in increasing their capacity. The CMU should also feature an external dimension, which is about connectivity with non-EU markets accessing international capital and global investors. The two dimensions are complementary in my view. For EU capital markets to thrive, it is vital to maintain and continue to develop open capital markets that are able to provide access to global capital pools and funding opportunities while ensuring market integrity and fairness of treatment between EU firms and third country entities. It will be important for the EU to continue to attract additional equity and debt investment from international investors. International investors and firms headquartered outside the EU can play an important role in helping to develop the CMU and build deep and competitive capital markets. With regards to the UK, it's essential to establish a close, cooperative and stable long-term relationship for financial services. It is paramount that the new EU-UK relationship minimizes fragmentation as much as possible, as that will enable companies, investors, pension funds, public bodies, and all users of financial markets to finance growth and manage their risk as efficiently as possible. And to close, I sincerely hope that Europe continues to build momentum behind the CMU project as a means of strengthening and projecting itself as being a competitive, safe, and growing place to do business. The EU's broader political ambitions, including in being open and strategically autonomous, are best served by exactly that. Open. Open for business, open for investment, not as a collection of capital markets, but as one united single market. We at AFME will continue to advocate and promote stable, competitive, and sustainable financial markets that support economic growth and benefit society. Thank you once again for this opportunity to speak on this topic. I hope that it is not long before progress on this path becomes a reality.
Well, Adam, thank you very much for that very interesting and wide-ranging review. And I think, as you can see from the policy suggestions there, that the CMU is an evolving project that still has a lot of work ahead of it. I'm now happy to hand over to our next section, which will be taking a reality check on the Capital Markets Union project so far. I'm now joined by Panagiotis Asimakopoulos, who is Head of Research at New Financial, a London-based think tank. He joined in September 2016, specialising in capital markets and Brexit. Before joining New Financial, he worked at DG FISMA for the European Commission and at NATO. Now, Panos, in November 2020, you co-authored a very interesting report looking at how far the CMU project has travelled since inception. Perhaps you could spend a few minutes to guide us through some of your findings.
Good morning, Chris. Good morning, everyone. I'm delighted to be here today and talk about our recent report, which is called the Reality Check on Capital Markets Union. So in this report, we have analyzed the changes in capital markets across the EU in 27 sectors of activity since the launch of the project in 2014, with a particular focus on convergence and the reliance of EU firms and households on banks. So there were three clear conclusions from our report. The first one is that there has been steady progress at an EU level in terms of growth in activity and in depth of capital markets over the past 5 years. Second, this growth has been patchy across individual countries and sectors. And third, the gap between countries with well-developed capital markets and less developed capital markets has widened. Let's look at this in more detail. So let's start with the range in depth of capital markets across the EU. This chart shows the wide range in depth in individual countries across Europe. We analyzed activity in every country across 24 sectors, and we have created an index of depth of capital markets, expressing this depth relative to the EU average of 100. So you can see the blue column to the left-hand side of the chart. What you can see on the far left is that Luxembourg has by far the largest capital markets relative to GDP in the EU, nearly 4 times deeper than the EU average. And you can see the light gray bar that US capital markets are twice as deep as in the UK, which in turn is roughly twice as deep as the EU27, which is the blue column on the right-hand side. Within the EU, there are 3 clear group of countries. So you have a small group of wealthy northwestern EU countries with well-developed capital markets. You can see them on the left-hand side of the chart. That includes the UK, Sweden, and the Netherlands. A second group, including 3 big economies of EU27, Spain, Italy, and Germany, in the middle of the chart. They together account for nearly half of EU27 GDP, but have notably underdeveloped capital markets. And finally, there is a long tail, which you can see on the right-hand side, with the most recent EU member states from Central and Eastern Europe, plus Austria, with less developed capital markets, around a third of the EU average. Let's look at this in more detail in this table. So this table shows the depth of capital markets in each country in 5 different groups of sectors. So we have pools of capital, equity markets, bond markets, asset management, private equity, and venture capital. We divided the EU countries into 4 groups, from those with the most developed capital markets, that is the top quartile, to those with the least developed capital markets, that's the bottom quartile. And in this slide, you can see the top 2 quartiles. And what you can see is that the very top of the table is that Luxembourg, the UK, Sweden, and the Netherlands are the only countries in the EU that are in the top quartile in all 5 groups of sectors. And I mentioned earlier Spain, Italy, and Germany. What you can see here is that they're in the second or even third quartile in every group. And here you can see the bottom 2 quartiles, the countries with less developed capital markets. So with the exception of Austria and Greece, these countries are the most recent member states to have joined the EU. And while these countries have relatively underdeveloped capital markets, they have made quite remarkable progress from a standing start 25 years ago. So let's now move to what has changed since the launch of CMU 5 years ago. This table shows the change in the size and depth of different sectors at an EU level. So we looked at 3 things: whether there has been an increase in the value of activity, that is the first column of the table, whether there has been an increase in depth, that is the second column, and whether the gap in depth between the EU27 and the UK has widened or narrowed, which is the third column of the table. So what you can see is that activity in absolute terms has increased in all but 2 of the sector we have included in this table, and relative to GDP in all but 4. But when we looked at all the 27 sectors we analyzed, the value of activity has increased in all but 4 sectors by an average of 40%. And relative to GDP in 20. However, it is important to note that in key areas such as equity markets, corporate bond markets, and trading, the value of activity in absolute terms has declined in around 40% of member states, and relative to GDP in more than half. Finally, looking at the gap between the UK and the EU27, we found that in more than half of the 27 sectors, EU27 capital markets have grown at a smaller pace than in the UK over the past 5 years. The positive news is that the gap in some key sectors, such as pensions and insurance, IPOs and corporate bond markets, has narrowed. Let's now put EU capital markets into a longer-term perspective. This chart shows the change in depth in the EU and the EU27 over the last 15 years. So the grey columns show the depth of capital markets, including the UK, and the red dot line, the EU27. Since the launch of CMU, the overall depth of EU capital markets has grown by 14%. And you can see that when we first did this analysis in 2014, we set depth to 100. And since then, it has gone up to 114. So while this growth is welcome news and provides a strong backdrop for CMU, it's difficult to attribute all of this increase directly to CMU itself. And much of this growth has been the natural process of recovery from the financial crisis and the subsequent Eurozone crisis. As you can see in this chart, EU capital markets reached their lowest point of 92 in 2012. As you can see on the left-hand side of the chart, capital markets across the EU27 are still today significantly smaller relative to GDP than they were before the financial crisis. As with most EU projects, a key measure of progress is convergence. So this chart measures the average depth of capital markets for each of the 4 quartiles over the past 10 years. The gap between member states with the most developed capital markets, which is the green line on top of the chart, and those with developed capital markets, that is, these are the yellow, red, and dotted red lines, is still big, and it hasn't narrowed. The small number of countries with well-developed capital markets in 2014 have seen the highest growth. Actually, 8 out of the 10 most developed increased in depth. On the contrary, countries with less developed capital markets have, in most cases, struggled to close the gap with the EU average. Actually, half of the 10 least developed capital markets have gone backwards. Overall, in a third of the EU27 member states, capital markets today are less developed than they were in 2014. Finally, Capital Markets Union at its most basic level is about reducing the reliance of EU companies to bank lending, and the dependence of EU savers on bank deposits. So to measure changes in reliance on banks, we have looked at 3 things. The first one was the structure of corporate borrowing, which is the value of bank lending versus the value of corporate bond markets. The second thing we measured was the structure of corporate funding, that is the flow of capital markets financing versus the flow of bank lending. And the third was the structure of household financial assets. This table shows whether the share of corporate bonds, capital markets financing, and cash deposit has increased, and whether the overall value of corporate borrowing, corporate funding, and household investment has increased since 2014, the launch of CMU. So what you can see is that at an aggregate level, the EU27 economy has become less reliant on bank lending. The average share of corporate bonds in total borrowing has grown from 19% to 23%. And the flow of capital markets financing has grown by around 10% at an aggregate level. And its of total corporate funding has increased from 11.6% to around 12.5%. However, there is still a long way to go, as the reliance on bank lending has increased in 11 of the 27 member states, and the vast majority of the shift from bank lending to corporate bonds is accounted for by just a handful of countries. Also, the share of capital markets financing has shrunk in more than half of the member states. And in most of those that it actually increased, it was due to a fall in the flow of bank lending. In more positive news, at the bottom of the table, you can see. So we actually looked at the structure of household financial assets, and you can see that the value of pension and insurance assets has grown, and it has grown in every country since 2014. And relative to GDP, it has also grown in the vast majority of the countries. And while the proportion of household financial wealth sitting in bank deposits is still high, you can see from the chart is still at 32%. The reliance on cash savings has decreased in 2/3 of the member states, and the value of investment in equities, bonds, and funds has grown in real terms in all member states, but just 3. So that was all from me today, Chris. And for more information about our work, request a full copy of the report. Or if you have any other queries, you can send me an email. I would like to thank you very much for your attention, and I'm looking forward to the rest of the live stream and an interesting debate on the future of Capital Markets Union.
Okay, thank you very much, Panos, for that very interesting summary. Some progress has been made, but still quite a long way to go in terms of convergence by the look of it. I'd now like to hand over to my colleague, Philipp von Restorff, who will be moderating a panel on the interplay between the CMU project and the European Green Deal. Thank you very much.
Ladies and gentlemen, after the industry perspective provided by Adam and the outline what has happened since 2015 in the Capital Markets Union, it is now time and my pleasure to moderate a panel which explores the interplay between the Capital Markets Union and the European Green Deal. And I am delighted to welcome here in the studio Anna Lindner. Anna Lindner is Senior Associate at GSK Stockmann. She focuses on capital markets, banking and finance, and corporate and sustainable finance. She's admitted to the German and Luxembourg bar and holds qualification from Maximilian University in Würzburg and Humboldt University in Bonn. From Paris, we have Jean-Jacques Barbéris, who is head of Institutional and Corporate Clients Division at Amundi, where he's also a member of the Executive Committee. Before, he was acting as economic and financial affairs advisor in the staff of the French president. He is vice chairman of the board of Finance for Tomorrow, a French financial association dedicated to sustainable finance. He is also chairman of a French think tank, En Temps Réel, which focuses on European policies. He is a young global leader of the World Economic Forum since 2019. Furthermore, we have Rainer Riess, who is Director General of the Federation of European Securities Exchanges. Rainer has more than 30 years of experience in the global exchange industry, and he is vice chair of Securities and Markets Stakeholders Group. He has experience in initiatives like the setup of the Deutsche Terminbörse Eurex. Welcome to you all. Rainer, I will start with you. And my first questions, how can capital markets support the transition of the EU to a low carbon and circular economy?
Well, I think if you look at markets, certainly having a higher share of equity financing means that companies are better equipped to handle economic shocks, create jobs, allow investors to participate in the value creation of fast-growing companies. And that is very much what CMU is about. But equally, you see that capital markets allocate very efficiently capital towards the most beneficial use. And certainly with the appetite of investors for sustainable investment, you see more and more money being allocated to sustainable economy. So I think simply by enabling that market mechanism, you will, I think, end up with a low carbon resilient transition. On top of that, I think obviously we need to, I think, have the regulatory underpinning, and that is certainly happening, and we'll be discussing that further on the panel. Climate transition. And I think in that sense, CMU and sustainable finance and all the initiatives are basically mutually reinforcing projects.
Thank you, Rainer. Jean-Jacques, what would be your perspective on this issue?
Well, thank you very much, and it's great being with you today. I think I would like to come back a little bit to what is the transition, I would say, if we try to define it from an economical perspective. For me, the transition is basically a depreciation of some activities versus an appreciation of some activities. There are some activities that we need to stop or we need to change, and so therefore we need to depreciate them. And that's where the market has, of course, a role to play by allocating capital and by reflecting in the prices this overall depreciation and appreciation exercise. That is what the transition is about from a financial market perspective. And therefore, how the markets can support the transition, I think basically, very basically, by over-investing into the companies that are going to be the manufacturer of the transition, and therefore the ones that are going to benefit from the appreciation of some activities, and to progressively disinvest or stop to invest into the activities that needs to be overall depreciated. So that's what I would say the market mechanisms can enter into play, in particular in a context where, unfortunately, even at European Union level, as we don't have a common price on carbon for very different reasons, so it's the market to discover the proper pricing in a way. So I think this is where markets can be useful, and I think here there is still a lot of job to be done. To give you a figure that I think is striking, if you take the European credit universe, so the companies that are composing the European credit universe, at the moment you find less than 50% of them, 42% to be precise, that are, I would say, aligned with a 2-degree perspective on an SBTi basis, meaning that so far we still have a long way to go to make sure that the markets are reflecting correctly the prices of this appreciation of some activities and depreciation of others.
Thank you very much, Jean-Jacques. Linda, you have heard there's still a long way to go. What would be your perspective on that to round it up?
I think I agree. There's a long way to go. We have just started with the getting the data, gathering the data that is needed from the issuers to actually find out whether they are sustainable or not. So we have the regulation in place for that now, and it's only kicking in. So there's a long way to go. We're at the start, and we need to continue from here.
Certainly true. So having heard all that, I wonder how could the Capital Markets Union could come into play here and help in addressing this challenge. Maybe Jean-Jacques, I give you the first hand.
No, thanks. Well, here I don't want to contradict what previous speakers have said regarding the Capital Markets Union, which is, of course, a project that, in essence, we totally support. But I think so far the results have been relatively limited, if we call a spade a spade. And when it comes to the participation of the CMU to, I would say, the support generally of the transition, I think so far the results are limited because it was not probably the most important area of focus. Where I think the CMU can help in the future is in particular in focusing on very concrete practical things that needs to be done and to be made to help the markets to support the transition and the Green Deal. And in particular, to be very precise, I think of two things. First, we are very much supporters of the idea of a single access point, so basically a common data platform on ESG and on the ESG, I would say, indicators being reported by corporates under the upcoming financial regulation, non-financial disclosure directive. So I think that's a very crucial key element of the new strategy of the CMU, where I think we should focus first. And second, I think also we know that the transition requests, of course, long-term investments, and we do believe that on that area, there are in the, I would say, future CMU, very interesting things to be done to provide, I would say, long-term investment schemes or long-term investment vehicles that are in capacity to support the transition. But my basic message is let's not focus about the strategy, but really on very pragmatic things. And for us, two priorities would be the ones I just referred to.
Thank you. So a single point of access and a long-term investment scheme. Anna, what would you think that the CMU could contribute in helping to address the challenge?
I agree. We have to have a pragmatic view, so we have to help businesses to make this transition work. We have to provide standards that are unified so that they can, with their cross-border businesses, navigate a common standard on not 27 different ones, obviously. So if we have a taxonomy framework, for example, it's clear it has to be unified. It's a mountain to climb for these businesses to actually find the data, to see whether they are sustainable or not, where they lack, where they need to improve. And it's very hard for them to actually climb this mountain if they have to climb 27 different ones. So we need one common approach, and that is actually what the market currently wants, and the answers are not fully provided yet, I would say, in the regulation.
Rainer, you in Brussels at Fese, you are very close to the decision makers there, and you probably have also a view and on that particular issue.
Absolutely. No, I would concur with what Jean-Jacques said, that I think so far the results of CMU have not been as we certainly have hoped. But I think Panos in his presentation very clearly showed there is no alternative. We need to, especially after, I think, the COVID crisis, when we look at the geopolitical financing of Europe, where we are in a disadvantage through less equity, coming already after, I think, out of a quite leveraged scenario, where bank financing may not be as available due to, I think, the problems in the banking sector, and simply a lack of equity. I think we need CMU for the sustainable transition to succeed. What does that mean? I think it really means that we need to unlock capital markets to a much larger extent. And I would probably contradict Adam there, who said we need a targeted review. I agree there with him. And I think we need a review where investors and issuers at the end are better off. However, when he, for example, was basically arguing we should keep the very complex system, and he was highlighting the numbers that AFME has produced on addressable and non-addressable, I think we're simply compounding intransparency and complexity. We need to have, for example, and that's where it starts, a tape of record that gives 100% view of what transactions are happening, that investors have trust, that they want to invest their pensions, to ensure that I think we have a fair pricing in the market, and that markets are really able to efficiently channel their investment into, for example, the most sustainable investments. So I would think, this is an exercise where we need to mobilize truly politicians to deliver on a capital market unions. And really, I think this is something what Anna said. We cannot live on with 27 capital markets doing their own thing. We need to in the union think about what we can harmonize to make the life for investors easier. And I think the point, again, that Jean-Jacques was making, for example, the ESAP provides that opportunity to simply make company information much more standardized and readily available.
Thank you. Allow me to dig a little bit deeper and to become a little more concrete. What needs to be done in practice for capital markets to integrate the green transition? Anna.
I think, well, we advise a lot of issuers, so I think what needs to be done is also putting the issuer a bit more in focus. I know that the investor is very important, but the issuer needs to deliver the product. The issuer needs to be able to actually align itself with the taxonomy, with the requirements of the investors. So it is very important that we provide incentives for the issuer to do so. At the moment, for example, when we look at the green bonds market, we see that they are only sought after by the investors if they're competitively priced, so maturity-wise. So that is not very attractive for the issuer, because for the issuer, they are much more expensive to issue. So this is a misalignment here. If we want to push for sustainability, we also have to keep the issuer and the costs that are related with sustainability for them in mind, and we have to provide incentives to actually make it an attractive tool. And I agree fully with what Rainer said. We have to increase the access to of market participants to capital markets, because if we have a problem to bring new businesses into capital markets, then how are we going to bring the solutions for tomorrow into the capital markets? How are we going to bring the new startup into the capital markets that has maybe this fundamental idea that needs to be addressed in our economy and in our, to transition truly into a climate-friendly economy here?
True. Jean-Jacques, as a representative of the asset management industry, what would be your view on that to be done in practice?
Look, I concur with a number of things that Anna just said. I think if you want to make sure that the capital markets can really allocate money where it should be allocated to support the transition, basically you need to work on the three dimensions. You need to work on the corporate side, you need to work on the financial participant side, and you need to work on the client side. On the corporate side, basically what you need to allocate more capital to the companies that are going to be the manufacturer of the transition, you just need more companies that are aligning themselves with Paris Agreement. I think that's ultimately what you need if you want to, I would say, make huge maneuvers of capital vis-à-vis the companies that are manufacturing the transition. Regarding financial participants, I think what you need ultimately is to make sure that these financial participants are themselves also taking commitments, but are also reporting on the alignment of their portfolios and what they are doing vis-à-vis the ultimate goals that we have, which is to be overall European Union that is net zero in 2050. And finally, I think you need to provide, I would say, simplicity and capacity of understanding to the end client to make sure that the end client, the end investor, the retail investor in particular, has the necessary transparency and is also pushing people like us to allocate the capital in the good direction. And to do that, you need to help the end client to, I would say, maneuver into the ESG jungle, if you allow me that expression. And for instance, the entry into force of a regulation like SFDR is going exactly in the right direction. And this is, we believe, this type of things that will help to progressively make the financing of the transition happening, really working on the three dimensions, the issuer corporate side, the financial participants, and the end client, which is someone that needs not to be forgotten. It's absolutely crucial. For the record, 80% of the growth of the ESG market last year in the EU was made by the retail.
Yeah. Rainer, you're probably discussing a lot this topic with your members. So what seems to be the priority on your side when it comes to concrete actions to be taken?
Well, first of all, I would fully agree with what Anna and Jean-Jacques have said, and maybe to add to that, and picking up on the last point from Jean-Jacques, I think empowering retail investors will be key. We need to, I think, unlock their potential, because this is huge what we need in terms of financing capacity in Europe. in order to make the green transition happen. So I think that is probably the one and big point that is also part of the CMU action plan, and I only can encourage I think politicians to be bold there. So we, I think, get a strong retail investor community that embraces this as the green transition. On the other hand, I think it is really, we're doing a lot in practice with the sustainable finance agenda, the taxonomy, and all the things. And I think we need to ensure that capital market raising activities really adhere to the sustainable financing, so all companies can be part of the necessary transition towards the sustainable future. That is difficult for them, and I think that was mentioned already. So we, for example, have issued some Fese guiding principles to ESG reporting to help companies to, I think, be more fit for what they need to report. It requires a long-term vision, and I think we also need to be careful there that this is not only done for listed companies, but also for private companies, because I think we don't want to slap yet another part of regulation on listed companies only, and that this is only happening sustainability will only be something for public markets. We need to ensure that this is across the entire spectrum, public and private.
That is certainly a very important point. Before coming now to the regulatory priorities, ladies and gentlemen, I would like to invite you to ask questions to the panelists, which you can do by using the window in your browser. We will take up your questions then at the end of this panel. Now, the regulatory priorities, you already said it, there was a regulatory burden in the recent years. So to come back to you, Rainer, what in your eyes, in terms of regulation and priorities, would be important in your eyes?
Well, I'll start with one I already cited in the beginning. I think the MiFID/MiFIR review, and Adam highlighted that, I think it's important because we need to get markets that function and where people have trust on. For example, last March, bond markets in Europe ceased trading for a few days and only again were able to start trading when central banks intervened. And I think that highlights that we need really markets that are fair, that have integrity, that have transparency. And I think this is where CMU, to me, and sustainability are very, very closely interlinked, and I think we need to improve the overall functioning of capital markets in Europe. Then I think we're very eagerly awaiting the NFRD review, and we think that's together with the sustainable corporate governance standards and green bond standards, those are very important activities, as well as the taxonomy. So I think, all of this is something I pretty much see as a holistic package that needs to be put together. And again, being mindful that what I said before, that should be, for example, all listed or non-listed companies above 500 employees or something to ensure that we have a broad coverage of the entire economy.
Thank you, Rainer. Anna, as a legal practitioner, what would be your view on these priorities?
I think it's important, Rainer said that already, to provide guidance because this transition is hard, and so the issuers need guidance, they need help, so this should be a regulatory priority to actually provide clear details on what needs to be reported. We see, for example, right now in the taxonomy regulation that non-financial corporates need to disclose information as of this financial year, only next year, but as of this financial year. But the standards and how they should do it are not final. So how can they do it? So they cannot really implement a system. The time frame is not really aligned. This is really difficult for them to tackle. And this is something that I think there needs to be more awareness for this. They have to do the heavy lifting here by actually working on the assets, on the actual real economy to actually make it more sustainable. So they have to also understand what they need to do in detail, and they can't just be pushed into the hot water and then they have to swim on their own, and then next year the standards come along and it's maybe completely different from what they expected. So I think here we need to focus more to actually not only apply the rules, but actually give the proper guidance with it and help and support where we can.
Jean-Jacques, does the industry need more guidance, more transparency, more clarity? What would be your opinion? here.
The sound.
I think you're on.
It seems that we have here some technical issue hearing you, Jean-Jacques. I'm sorry to interrupt.
No?
Yes, I think you are back now.
Okay, sorry, I don't know what happened. No, I was just saying I'm going to dare to give a piece of advice to the European Commission, as my understanding that Commissioner McGuinness is working on a new sustainable finance strategy. I think basically what we need is a strategy that is focusing on sovereignty, on influence, and on speed. On sovereignty first, because let's be clear, we are at a moment where we're going to have a battle of standards at worldwide level regarding what are the transition standards. And I don't think that we will have the same view between notably the US and the EU. The EU has taken the leadership on that front. We need to keep that element of sovereignty and to make sure that we are not being imposed standards that are not ours. So I think that's the first element. Second element is to focus, therefore, on influence. We need to export everything that has been done at the EU in other jurisdictions, trying to make sure that the standards we have manufactured are the ones that we are in capacity to, I would say, share and potentially impose also elsewhere, again, because otherwise I fear that these standards will be imposed on us. If I think back to the metaphor that was used by Anna on the 27 mountains, personally, I like 27 mountains as a cyclist, but I think let's assume we have one single mountain with a nice one regulatory framework. The thing we want to be sure is that we climb the mountain on our own bike, and not a bike that will be exported by someone else or another jurisdictions. So I think sovereignty, influence are absolutely key. And finally, the last regulatory, I would say, priority is the speed. NFRD is going to be, I would say, a welcome revolution for everyone with, I would say, better standardization for corporates on what they need to report to an ESG. But we shall not wait during 3 years to manufacture the standards. We need them as soon as possible because we're at the beginning of a decade where we are creating the transition, and therefore we shall focus on speed. So honestly, I don't think we need not that much additional regulation. We need first to defend properly the one we have vis-à-vis other jurisdictions, try to impose it the maximum possible. It's in the interest of the European Union and its participants. And finally, we need to deliver super fast on what is still on the ground and that is not, I would say, applicable yet.
Thank you. We have heard it before from Adam that the Capital Markets Union main aim is to finance growth. So again, on a practical level, you mentioned the contrast between the US and Europe, and another big contrast would be that most of the financing here in Europe is done by lending. So my last question would be how to give a better access to SMEs and corporates to access capital markets. And I would start with Jean-Jacques.
Well, I think if I may, by definition, I think it's important that the markets are getting, I would say, bigger at European level. At the same time, the structure of the financing of the EU is as it is. And therefore, what I mean by that, it's important also to focus on the banking aspect. So, for instance, to ensure that within the book lending of banks, these, I would say, elements of the transition are fully incorporated. And this is something that we shall not forget if we want to make sure that we finance the transition, because the transition will be financed at European by mobilizing the markets for sure, but also making sure that we align properly, I would say, the banking system vis-à-vis the objectives of the transition. So that's one thing. And second thing, I strongly believe, and we are a strong believer at Amundi, that to get better access to a capacity of financing the transition for SMEs, we need the development of new asset classes. And therefore, this is, for instance, why we launched with the European Investment Bank a program called Greco that has the ambition to develop 3 segments of the fixed income market at European level to support the transition of smaller entities, basically green high yield, green securitization, and green private debt.
Thank you, Jean-Jacques. Rainer, what would you say about that?
Well, I think there's of course many ways to improve access to capital markets for companies, and I think I will maybe resort to the European IPO task force that also looked very much at sustainability in 2020. And I think the report that they did really ensured a few points. I would cite the top 5. To have a level playing field between public and private companies. I think something that has been probably neglected in the past, where we still, for example, have some disadvantaging of public companies and certainly more regulatory requirements. We need to have more proportional requirements for smaller companies, and I think that is especially true for ESG. You cannot expect the same level of detail in disclosure, obviously, from a smaller company than from a big company. We need to encourage, and Jean-Jacques, that I mentioned it, that really pension savings through equity investment, both retail and institutional, are channeled into markets in a much larger degree. We have a huge pool of capital sitting in savings accounts with 0 interest. We need to mobilize them. We need to promote a dialogue between companies and their shareholders and really guarantee that company information, especially on sustainability, is easily accessible. We mentioned ASAP. And last not least, it is about equity culture. We really need to get financial education of investors, companies, and advisors, I think, to be holistically there. And that's, I think, a big task for all of us day by day, and the schools and the universities, to really ensure that equity culture will flourish.
Indeed, and education would be a key point there. Anna, to close up the discussion, what would be your view on helping SMEs and corporates accessing?
I can actually fully concur with Rainer. We have to level the playing field. We have to decrease the complexity for the smaller companies, because it's very complex to be a publicly listed company, and this is something that a small company that is in a growth phase cannot stomach this way. So level the playing field so that the difference is not so big anymore, and also decrease the complexity in accordance with their size, so that they can actually start and get used to it and get bigger and then handle the complexity.
Ladies and gentlemen, we have some minutes left, so I would ask my colleague Chris if there are any questions that have been asked by our viewers.
Sure. So thank you very much first to all panelists for a very interesting discussion there. The first question that's come in from the audience is, if we project forward, say, 5 to 10 years, do you think there'll be a distinction between ESG securities and other forms of securities, or do you think that the ESG framework will have become so embedded within the standard securities law that there is no distinction anymore? What are your views?
So 10 years from now, will there still be ESG securities and normal securities, or will this all be embedded? Rainer?
I think this is going to, I think this is really, capital markets work very rapidly. And as I said before, their aim is to direct capital into the most efficient use. That is why sustainability now is what institutional investors, what retail investors are looking for. And I think companies simply will not be able to afford to resist that trend. We already see that now happening. So I think in 10 years' time, as already now, this is, I think, something that will more and more be integrated for all companies, in my view.
Jean-Jacques, would you concur?
I would fully, just for the record, at the moment, everything being equal, if you're and in one dedicated sector, if you're a company that has a better ESG score compared to your peers, you have a higher stock price and a lower cost of capital. That's as simple as it is. This is already a reality on the European market. And I think, basically, we are living at the moment a parenthesis.
where the market is moving and shifting towards ESG, but clearly the market is going to be totally 100% ESG, and I'm absolutely sure, and by the way, I sincerely hope also as a citizen, that it will take much less than 10 years.
Anna, will this be your daily life in 10 years?
I fully think so, absolutely.
Okay, thank you. Chris, another question, please.
Yep, sure. So obviously, as we navigate this change towards ESG becoming basically commonplace, we've had this question coming in around greenwashing. So there's obviously an increased risk of greenwashing as ESG becomes more attractive. Do you think that there needs to be regulatory action to deal with that kind of issue, or do you think that there are other ways of tackling it from a markets perspective?
Jean-Jacques, as the Vice Chairman of Finance for Tomorrow, I think this is something you have been discussing a lot in the recent years.
Yeah, but I think that, but there is, let's be clear, I think greenwashing is putting any of the market participants at a massive reputational risk. So I think we can hope that there will be a self-discipline of the market participants because of the reputational risk associated, but clearly it's not enough. And for sure, there is a need and a strong need for regulation on that front. That's why SFDR, it's a progress. It's not something that I think is answering to the question per se, but clearly it goes in the right direction. And indeed, there is a need for additional regulation. There is a need for additional regulation on ESG providers, on ESG, I would say, rating agencies, on the way asset managers are integrating ESG. This is to be transparent, and regulators should have a look at that. So definitely we need that. And again, I think we need it also because at European level, we have a regulatory leadership on that front. We have also a business and industrial leadership on that front. We need to protect that by showing case and ensuring of the integrity of what we are doing regarding ESG. Otherwise, I fear that other participants that might be a little less virtuous than what we try to be will take our position in the future. So I think definitely we need to defend the integrity of the market, and here regulators need to involve, and they start to involve vividly, which I think is a very good news.
Rainer, self-discipline and regulation to address the challenge of greenwashing. Is this your stance too?
No, I would fully agree with what Jean-Jacques said. I think we need to certainly have the regulatory work done, and I think that's happening in a very good manner in Europe. We need to ensure, and that's maybe a complement to what Jean-Jacques said, I think we need to ensure that we're one of the standard setters globally for sustainability. This is a one-time chance for Europe. The Chinese are not sleeping and are also working on that. The Russians are working on that. And as of late, also the US. So be clear, this is now where we need to forge the standards that are credible and that ensure integrity of the data and that avoid greenwashing.
Anna, we are a trendsetter from a legal point of view. What would you say as an expert?
No, I would agree that we are currently trendsetters, and I think that greenwashing at the moment has also this problem that we just have not had before the taxonomy, really this fully aligned approach, what is green. We have the Chinese standard that is different. We have upcoming US standard that might be different. So the question is also, what is green? So that is also always behind greenwashing.
Coming back to clarity. We have time for one more question. Chris, is there another question?
Yeah, sure. So just as a last one, one of our audience picked up on the use of the term equity culture in your speeches. And he was wondering how exactly, would you define it, and what should be done to actually encourage retail investors to participate in capital markets in Europe? What are your views there?
Rainer, how to involve retail investors?
A big question. I think Panos spoke a little bit on the need of, empowering European capital markets. So I think he did a very good presentation on that in general. If you look really, there is billions stored away on savings account and normal cash accounts that bear 0 or negative interest rates. where simply people are losing money. And we're not smart investors in Europe in the sense of investing that into equity, where we are obviously, letting citizens save for their pension, have the participation in governance, etc. So I think all of this is certainly why this is needed. How to do it? I think, again, we need to make investors trust into markets. They need to see that this is fair, that there is integrity, that there is transparency. I think this is where, for example, the MiFID review is key. But I think we need to start, and I said that before, with education. That starts in school and universities. And I think politicians really need to mobilize much more, I think, in their countries, that an investor climate is coming, I think, to the fore. Panos very clearly said, in the UK or the Nordic, Sweden, that is clearly happening. And I think it's a culture of investment where people are simply being educated that it is beneficial to invest their pensions into equity, and where people are more cradle to that. I remember from my youth when I did an exchange to the US, the difference was equity investment was discussed at the dinner table, something I didn't know from Europe. And I think this culture we need to get.
Thank you, Rainer. Anna, what would be your response to that question?
I fully agree. Being married to an American, I know that there's a difference between the culture in Europe and in the US. So I think there's two aspects. We have to educate and we have to improve the culture in that way. But also what Jean-Jacques said, we also have to accept the culture as it is and have to find maybe other ways to find the middle, because we will probably not fully change the culture of Europe. That's just who we are to some extent. So.
Okay. Jean-Jacques, a final word from you to sum it up.
I think first we still need also the European citizens to continue to invest in fixed income, because just for the record, we have a little amount of debt to finance, so it's important also to keep that in mind. I think the sustainability journey is also a very good moment to not to change the culture, but at least what I can share is that based on our experience in the retail sector, when you introduce into a retail range, I would say equity products with a very strong, I would say, ESG objectives, thematics, and indicators, this is something that creates spontaneously much more appetite than for a traditional equity at the moment. And for a very basic reason, I think all the European citizens are wondering themselves how individually they can participate to fight against climate change and to help and to support the transition. They wonder how to do that as citizens. I think they wonder also how to do that as potential investors, even for small amounts of money. So I think here there is also an opportunity to probably present some, I would say, innovation products that are invested into equities that will finance the transition, and therefore that would create an appeal for the European investors in the retail sector.
Thank you, Jean-Jacques. Ladies and gentlemen, you heard it. It is still a long journey to go. There are challenges, but also opportunities. And we have to educate, raise awareness, and continue to promote green finance. I would like to thank Anna, Jean-Jacques, and Rainer for this interesting discussion. And I would now like to hand over to Josée Weydert, Managing Partner of NautaDutilh, discussing with their panelists securitization, a new asset class. Thank you very much.
So welcome on this panel on securitization in relation with the CMU. Luxembourg has developed a lot of expertise in securitization over the last 20 years, which has been fully supported by the flexibility of the securitization law of 2004. Now with the CMU, but as well the current situation of COVID, Brexit, and the need for funds, it seems to be the ideal moment to draw conclusions on the current situation and as well to see what are the concrete needs of securitization to be able to serve originators and investors. So I'm very happy to welcome on this panel Holger von Keutz as well as Oliver Shimek. Holger von Keutz is the head of securitization practice at PwC. He provides financial and regulatory advice on the setup of securitization vehicles and has an experience of around 20 years in that area. He has written a lot of publications in relation with securitization in Luxembourg. And in addition, he is very often on panels and conferences in relation with that topic. Furthermore, I would like to welcome Oliver Shimek. Oliver is the founder and CEO of CrossLend, a fintech company which is providing innovation, technology solutions to investors and to lenders. Oliver will tell us more about the opportunities technology will offer in the securitization area, in particular in the future in relation with CMU. So welcome both. The first question would be to Holger. As expert in the securitization market, how was the market impacted by the actions of the CMU? And do you see a shift from the traditional securitization model to an open market securitization with free access to asset and credit exposures?
Josée, thank you very much for the kind introduction. To assess the impact of the CMU, I think we need to go back and look at the intention of the CMU. The main goal at that time was to create a single market for capital, and in which companies, especially small and medium entities in Europe, will have better access to non-bank financing, and in which local capital markets will be deepened and better integrated. There was in November, there was a special report from the European Court of Auditors. And the European Court of Auditors, they have assessed whether the Commission has been successful in its actions towards building a capital market union. A good indicator, for example, is the diversity of the funding sources for a company. So meaning, is there still the bank financing or are there other ways of financing? And in addition to this, if there is cross-border financing, so if a company in Germany is not only financed by German companies, but also maybe by Portuguese companies or whatever. And the overall conclusion of the European Court of Auditors was that the Commission has made efforts to achieve this goal, but there is still a way to go. For example, they said the measures for diversifying the funding sources, they addressed issues that were too narrow. To initiate really a structural shift towards a non-bank financing. So we had only a limited impact especially for the SMEs. In addition, there was the Securitization Regulation, which was implemented. This was a really positive step, so creating one single rule book for securitization in Europe, especially to have a recovery of the securitization market after the crisis in 2007, and also to help banks then to increase their lending capacity. Transactions currently are still concentrated on traditional asset classes, mortgages, auto loans, and so on, and really concentrated in certain member states. If we look at the bank financing, for example, of the SMEs, still most member states' economies still rely heavily on bank financing rather than on capital market financing. So financing through bonds, private equity companies, or venture capital, and so on. Although the non-bank financing has increased, so currently there's around 50%, almost 50% of the total debt financing is with banks. In 2007, it was more about 60%. So there is a small increase of non-bank financing. But the important aim of the CMU to reduce the bank financing, is still not reached. If we look at the securitization in detail, with the Securitization Regulation, there was the STS label, simple, transparent, standardized securitizations, which was implemented, and what we see currently, that around 40% of the new issuance on the European securitization market have this label of STS, which is good, which shows there is the acceptance of it, but was there really a boost to the total recovery on the market? I don't think so. If you see the figures, 2020, the securitization market still decreased by 10% compared to 19. And we are at the level of, let's say, 2010, 2011, so after the financial crisis. There was no real recovery. And especially addressing the CMU, so SME financing, we see that only 8 out of the 450 STS labels are linked to SME loans. So there's a good trend, but I think traditional securitizations is still too big. But on the other hand, STS label creates trust, good, better reputation in the securitization market.
Very interesting. And so how do we currently use securitization then in the Luxembourg market?
Not so easy to say, because there is no official statistics on the Luxembourg market. What we do at PwC, for example, we always scan the Memorial, the Registre des Commerces, see how many vehicles have been created and so on. We also checked it this year with the CSSF. They are doing the same, and we compared the figures. Again, thank you very much to the CSSF to compare the figures. What we currently see, end of January, we have 1,315 vehicles active on the market. Out of these 1,315, there are 1,255 securitization companies and 60 securitization funds, which is only 5% of the total market. The 60 funds are then managed by 40 Mencos. Also in 2020, there was an increase, a slight increase of the market. We saw 126 new securitizations, but also 95 liquidations, which leads to a small, slight increase of the market. Not that much, but a little bit. The reasons, I would say, first of all, is COVID. Now we have seen the whole capital market was a little bit lower in 2020. Deals were put on hold, especially in the second quarter, I would say, during the year. And there was also still these discussions on ATAD, the Anti-Tax Avoidance Directive in Luxembourg, how it will be implemented. Finally, at the end of the year, there was the paper issued by the tax authorities. Still the first paper, there's another one to come, which still needs to clear some unclarity on the market. You mentioned asset classes. What are the asset classes in Luxembourg? I think we still see trade receivables a lot, auto loans, leasing transactions. These are the traditional ones. But also what we see, especially in Luxembourg, is fund repackaging. So Luxembourg, a big fund place. There's another distribution channel to repackage the funds and then to distribute it through notes which are issued. And a lot of structured products, especially on the regulated entities, are also issued.
Very interesting. So let's come to Oliver. You created a securitization vehicle which perfectly fits in the CMU idea. Can you explain how this works and if the goal was reached? Are there any particular difficulties you met, and are there any disadvantages in using this model?
Yeah, so first of all, the SPV is one piece of the technology that we provide to the market. I think we are very much following the ideas of the Capital Markets Union, potentially discovered also over time that there's a little bit of a broader scope required, because I think the things that Holger mentioned were securitization is working well, and then in other segments where we do not see that much transactions happening, they have a reason which didn't really change over time, and we're trying to address that through technology. So any debt transaction typically goes through several stages until it then finally is potentially being securitized or repackaged or whatever. And what we see in the Capital Markets Union approach that has happened over the last years is that those first steps are a little bit left out, which has to do with data onboarding, with data decision making, data availability in the banks. And this is where CrossLend's offering starts. So we provide data onboarding and cleaning technology for banks, where banks and also alternative lenders can onboard their data stack and clean the data, repair mismatches in the data, and make them available to then, in a second step, derive decisions like, for example, do I keep this particular asset on the balance sheet, or do I want to sell this particular asset? And then in a third step, we provide market infrastructure, and market infrastructure means that we either connect an originator with an external investor in the spirit of the Capital Markets Union, also mostly on a cross-border basis. But market can also mean an internal market. For example, if you think about syndication within large banking groups that are similar, or also asset rotation within large banks that have multiple assets, multiple balance sheets. So these are typical applications for our internal marketplace technology. And then as the final step of the overall process, once the assets have been made available for a transaction, once the parties have agreed to a transaction, then we apply a securitization framework which works out of Luxembourg. And the beauty of that is that it's a very pure, untranched securitization, where basically the assets are wrapped into notes and then transferred from the seller to the buyer. And I think, like, when one after several years now takes a resume of where the Capital Markets Union stands, then I think the scope needs to be a little bit broader. What was defined as an initiative to make cross-border financing possible, but in the end, the broader scope is about asset mobilization and asset mobility in general. Because if we for a second assume a world where all the assets of a balance sheet are present in a digital format with perfect data availability, then and also in a standardized format, which other market participants understand, then it is pretty clear that the market will develop more or less itself. I think the Capital Markets Union started a little bit from the back or the end of the overall process, and took care a lot around how do I transfer assets and how do I build an integrated market. And I think it is now a very good time to look a little bit further towards the beginning of this overall process chain, and make sure that the various participants from alternative lending or also the traditional banking industry can actually participate in such a market. And this is where CrossLend provides the full spectrum technology from end to end.
So thank you very much, Oliver. So question to Holger, as the idea of transferring risks to a securitization vehicle and sharing risks positions between many market players is as such a good idea. Would you expect any change in the position of the European regulator to come? And what are these changes you would expect to enhance securitization?
I think there's still some improvements that we can see in the regulation. And we take the example of Oliver's vehicle, CrossLend, which is a Luxembourg securitization vehicle, but I will explain later on, it's not a European EU securitization. So the EU Securitization Regulation has defined a common framework with common rules, common definitions, which creates then a single rule book for the EU. And also, what I mentioned already, the STS framework was implemented there and introduced, and it is really appreciated by the market. One point on the STS, because these are, let's say, high quality securitization, is that, for example, the capital requirements for bank investors, they are lower than on non-STS securitizations. So there is an intention for banks, for example, invest in STS securitizations, and there is also an intention for the originators, for the arrangers, to produce STS securitizations because they will attract more investors, and the investors do not need to have that much capital requirements. Even if we see that the capital requirements for STS securitizations are slightly higher than before the change in the regulations. One point, especially to Luxembourg, we have a securitization law since 2004. And in Luxembourg, the securitization is defined of purchasing a risk and issuing securities. So quite simple, risk and issuing of securities. In the EU Securitization Regulation, the definition is a little bit different. They say you need to purchase a credit risk. No? Not market risk, no commodity risk or whatever, credit risk. So a small limitation. And they say securitization is when you issue two types of securities which are subordinated, so meaning tranched. No? Luxembourg, so the EU Securitization Regulation is only a part of the broad scope of the Luxembourg securitization law. And this what we see here in Luxembourg is that we have many securitization, and for example Oliver's CrossLend vehicle, which do not do the tranching. We just transfer risk from one party to the other. Simple idea, without having different risk different risk affected with the different nodes. And for the CRR, for the banking investors, these non-tranched vehicles are not seen as securitization, which is, first of all, it's quite good because they are just a corporate risk. But if you look into this a little bit deeper, if you compare this, for example, with a fund, with an alternative investment fund, with a UCITS fund, where there is a possibility to look through the risk and see, okay, who is really behind, and then you can apply, for example, the credit risk of the underlyings. Here, in such a vehicle where you don't have any tranching, you cannot look through. Even if from an economical perspective, it's the same. The investor gets exactly the risk of the underlyings and nothing in between. And that's why I think that it would be good if we would have the same treatment of these, let's say, non-tranche securitization, or let's call it more general pass-through vehicles, that we can apply the same rules as for the alternative funds and for the UCITS funds. I think that would also help to boost a little bit the securitization market, because I hear it also from some clients, they would like to invest in a vehicle which are securitizing a lot of SME loans, for example, but they cannot, or for example, mortgage loans, which are quite sure, quite secure, and they cannot apply unless the regulator approves it, they cannot apply a lower rating, even if the risk is really lower. And if I would have a wish for the regulatory part, this is something I think this would also boost a little bit the SME financing in Europe.
Mm-hmm. So let's hope the regulator will hear us.
Yeah, I hope.
And Oliver, can you confirm this from an issuer's perspective as well?
Yes, I think one of the, and this is a symptom of the overall conversation around capital markets union and securitization. I think it is not thought from the end, from the use case. What do banks, what do lenders, and what do investors actually need? If you want to achieve the goal of an integrated market where origination takes place somewhere and someone else in another country takes the risk of that origination, which is the idea of the capital markets union of an integrated market, then what you need to do is to achieve a pure risk transfer between those two parties, which doesn't leave any room open for interpretation of the local regulation. And what we see here is a little bit of a vacuum where it is not, where the Luxembourg securitization law isn't been fully understood in other regions, and this creates a problem because the different countries and the different originators and investors operate under different assumptions. So we are very far away from an integrated market. And the reason is that the question was more asked, how do we improve securitization in the EU securitization sense? And yes, we have STS and so on, but the reality is that for most of the use cases that we see in the market, and that would require or would be required to unlock today sticky assets, they're not solvable with traditional securitization. These are highly agile transactions. For example, if you take an originate to distribute transaction where origination is being produced on an ongoing basis and needs to be transferred to an investor. So if you think that through in terms of securitization, what you require is a warehouse in between, so these whole setups get awfully complex. And to me, this always feels a little bit like, okay, we are a car manufacturer and there's a combustion engine. So how do we make this combustion engine a little bit more green? But somebody has to take a step back and say, why don't we need a combustion engine? Let's electrify that thing. And this is what's a little bit missing in the overall conversation. And to Holger's point, the complexity of traditional financial transactions is extremely high. And what we're doing is we are making more and more rules and trying to adapt a complex thing to an even more complex use case, instead of saying, okay, we actually need a pure risk transfer mechanism. So we have seen all those conversations around blockchain and about like funds and securitization, STS and all that. They're all a symptom of the problem that we are not satisfied with the risk transfer mechanisms or the way those are being treated on a country by country basis that we have available today. So I think if the discussion about the capital markets union is supposed to be successful, then one has to think things from the end. What do we need in order for transactions to actually happen? It's a standardized, simple risk transfer mechanism that everybody understands without any schnick-schnack. And we need data availability and data standardization. And there's so much pressure from the market, whether this is coming from the MPLs or whether this is coming from the SME financing sector or the mortgage sector. There's so much pressure on the market for transactions. So I think it's very safe to assume that once we solve those problems of data standardization, data availability, and then a pure risk transfer mechanism, that a market environment will be created out of its own. So there isn't even the requirement for for initiative anymore. So, and in this spirit, I totally agree to what Holger says. I think the next steps, the next logical steps that have to be taken on the regulatory end are as a much simpler step and approach towards securitization and risk transfer. And I think Luxembourg is exactly on the right way. But we see in practice that regulators across Europe do not understand this mechanism.
Interesting. So, Oliver, the new technologies then offer real opportunities for the financial sector, and in particular, securitization, as you see it.
Yes, absolutely. I mean, as I mentioned in the beginning, transactions go through stages. So there isn't a portfolio just ready for securitization. There is a process before, and today these processes are awfully slow and complex to some extent. And then also a typical securitization always requires a large pool of assets. By definition, you exclude the majority of the market participants because everything around alternative lending or the regional banks all across Europe, and especially smaller banks in this very fragmented ecosystem, they are to some extent either excluded or the barrier for them is quite high to interact with traditional securitization in any form or shape. So the true challenge is to go back in that process chain and understand how can we make the process in the beginning more digital and make sure that whenever a loan is been originated by a bank, this loan actually exists as a digital twin or a digital asset in the system of the bank. Because once this is the case and we have this as in a digital representation within the bank, then it is very easy to move it also to other banks or to insurance companies or however the transactional flow is supposed to be. And I mean, all the conversations that we've seen also taking place in Luxembourg to a large extent around blockchain, they have been addressing exactly this problem with potentially a slightly naive approach, but it was good the way those discussions actually happened, because the mobilization of assets is really the first and most important step. And once this has actually taken place, then a primary market can develop, and once a primary market is up and running, a secondary market can develop. And if you think this through, then the prevention of transactions due to missing capital markets infrastructure and missing data technology, namely the missing digitization in banks these days, is one of the single most risks or most important risks that we have in the financial ecosystem, because a lot of the risks that we also treat in a regulatory sense are, if you follow them back to their root, actually technology risks, and therefore I think the core paradigm shift of the capital markets union conversation has to be that we shift more attention towards the bank, the digitization of the bank, and force digitization in banks, because otherwise we can talk about securitization all day long. We will build, to stay in the picture, we'll build a perfect car, maybe even with an electric engine. It will be awesome, but it doesn't have a steering wheel. And that's going to be very difficult to maneuver in the end. And therefore, yes, technologies provide a value add here. They are not widely adopted by banks. This is also a fact. So we see initiatives within banks that are not being harmonized. So I think a unified market would also require initiatives to make sure that data standards and technology standards, also API standards, are met between banks. And I think then there's really opportunity to boost the overall market velocity significantly.
Interesting. And Oliver, what do we then need to do to implement the digital opportunities concretely, what steps are to be taken then?
I mean, in the end, there's whenever there's risks in financial institutions, typically regulation would step in and oppose rules that are there to to make the bank more stable or the financial organization more stable and protect the overall stability of the system. I'm missing that on the digitization end. So digitization of banks is being left to the banks themselves, which in some banks works better than in others. But the reality of the capital markets and I mean the equities capital markets shows that the valuations of banks have been crushed over the last a decade. And the reason is that the broad majority doesn't trust that the banking digitization is happening fast enough. And there's a real risk that other players, the digital players, the large digital players in the banking environment or in the overall ecosystem are actually taken over parts of the profitable value chain of banks, and that the remaining more risky piece of the value chain is being left to banks. And I think what's been required is a strong push towards digitization in banks, potentially even enforced through regulation to some extent, because it starts with systems being used where no developers are basically in their working life anymore. So you can imagine that if such a system, for whatever reason, needs to be repaired, that's a real issue for the bank. And then the overall process chain, whether it's payment, whether it's lending. So these are, to a large extent, all very manual processes still. And I think one example where this is particularly present is think of a customer that goes into a store and finances a TV with his credit card. So these are three transactions with three different departments of the bank being involved. This is payment, this is a lending process, and then the credit card that most likely is being securitized and sold to the capital markets. So we have three engine rooms of the bank being involved with a single transaction instead of moving everything to a digital carrier, which guides us through the whole transaction. So it is really a must to enforce digitization, because I think what we've seen over the last decade is that if we leave that entirely to the bank and think this is happening on its own, we will just create a risk of all the people putting hard work into securitization, but then understanding at some point that the players in the market can't actually interact with one another in a digital and high frequency way, and therefore we must fix all parts of this transactional chain in order for transactions to be fluent in the market.
Thank you, Oliver and Holger, for your input on these questions. We see actually that there are a lot of opportunities to render the securitization more accessible for everyone. In particular, the use of technology is key in that process, and it would allow to free up capital for new funding opportunities. So let's follow up on that and see how regulations and the market will develop further. Thank you.
Thank you.
Well, thank you very much, Josée, for that very interesting panel. And indeed, thank you for all our speakers today, which have guided us through this complex topic that is the Capital Markets Union. I think one of the key takeaways for me is how much CMU impacts on basically everything we do, be that green finance, be that the digitization of the banking framework, be that even the real economy in terms of making that move between investments and companies. Thank you for joining us today. Please don't hesitate to check out our website, luxembourgforfinance.com, for more information on upcoming Focus On events. And also, last but not least, thank you also to our sponsors today for helping us put on this event. Thank you and goodbye.